Hi, good afternoon, everyone, and welcome to the Epilepsy Foundation of Connecticut Winter Webinar Series. This is Monica Anzalone. I'll be moderating today. And for the purposes of sound quality, everyone has been put in listen-only mode, but we do welcome you to type any questions that you have. On the bottom of your screen, you should see a little chat bubble, and in that area there below, you should be able to type your questions in. Those questions will be read and answered at the end of the presentation today by the presenter. Our presentation has been designed to help special needs families reach a greater understanding of some of the different government benefits available, such as Supplementary Security Income, Medicaid, Social Security Disability, SSDI, and Medicare. This will include how to qualify for these programs, and then also the differences between them, which we know can be challenging to understand. I would now like to introduce our presenter, Michael Beloff, CFP, he is a wealth advisor at Stratos Wealth Management, and he has been inspired by his son, who has autism, to become a chartered special needs consultant with extensive training and continuing education on the complex topics and particular challenges of caring for a dependent with special needs, including the constant changes in federal and state laws. Michael's expertise and ability to educate and empower has made him a noted speaker on the topic of special needs planning at both national and local venues. Michael is a board member and treasurer of Abilis, which is a nonprofit organization serving intellectually and developmentally disabled individuals in the lower Fairfield County, and is a member of the First Selectmen's Advisory Committee for People with Disabilities in Greenwich, Connecticut. I would now like to hand this over to Mr. Beloff. Thank you for being here.
Thank you, and welcome. We're going to go through a lot of things today, and we're going to talk about a lot of different topics, and hopefully make sense of some of these things. And I'm coming this kind of from three angles. I am a professional working to do long-term planning for families with a family member who has a disability. But as was mentioned, I'm also a parent, struggling with the same issues that you are. My son is 20 years old and in the school system and is going through the challenge that takes. But I'm also a board member of a social service agency that deals with children and adults with intellectual and developmental disabilities. And so this information is kind of coming from all three angles. But let's start and see. There we go. Just some disclaimers. So we're going to talk about two different types of benefits. The first are means-tested programs, which are programs available for those who are disabled under the law, who have limited access to assets and income. Those programs are Supplemental Security Income, or SSI, Medicaid, Supplemental Nutritional Assistance Plan, SNAP, formerly referred to as food stamps, remember that term, and Section 8 Housing Choice Voucher Program that's available for low and moderate income folks. There are also some non-means tested programs that are benefits available to individuals who have meet the definition of disability under law, but have access to assets and income. Those include Social Security Disability Income, SSDI, Medicare, and ABLE accounts. And this is kind of gives you a kind of a graphical view of the type of benefits that are available. Again, means tested, meaning you have to meet certain financial criteria to access them. Benefits that are not means tested, meaning that you can access them regardless of the individual's assets and income. And again, they're broken into two categories: monetary benefits, meaning they are monetary or money-like instruments that are given to individuals to help support them in living, and medical benefits. And we'll go through the difference. So first we want to start with, what does it mean to be disabled? Just because you have a disability, that doesn't necessarily mean that it rises to the point where the government feels that you deserve help from them. And there's actually a difference between the definition of disability. I call it federally disabled. there's a difference in the definition of disability depending on your age. So if you are under 18, then you're disabled if you have a medically determined physical or mental impairment, which results in a marked and severe functional limitations and can be expected to result in death or has lasted or will continue to last for more than 12 months. And again, so what that means is if you're under 18 and you have a severe impairment, you are considered disabled and you may get access to certain benefits, such as early intervention, birth to 3, if you're a child with a disability who is under the age of 3. Once you turn 18 and that person becomes an adult, the definition of disability changes to essentially you're only disabled as an adult if your disability prevents you from working. The substantial gainful activity it's referred to in that second definition means you can't work. But the government has a very limited definition of what it means to not be able to work. And that definition of substantial gainful activity in 2018 is that you can't earn more than $1,180 in an individual month. That would break out to about $14,000 a year. If you are able, it doesn't mean you're currently doing it, but if you are able to earn more than that substantial gainful activity amount as determined by Social Security, then you are not disabled under the law, and then you're probably not eligible for the benefits that are indicated here. And that's very important, especially as you're going to navigate through the adult system and try to get supports from an adult with disabilities. It's important to realize that limitation. Down at the bottom, you're going to see, and on some of these slides, you will see references out to where this information comes from. And so a lot of this information can be garnered from the Social Security website, although it is not easy to navigate sometimes, and the definitions and where to find things and what they mean is not always clear. But when we talk about disabled, we're going to talk about the federal definition of disability and what that means. So we're going to start with the means-tested benefits, what you get if you have a disability and you meet the financial criteria to get them. And the first one is SSI, which is Supplemental Security Income. This can be considered a welfare program. Even though this program, SSI, is administered by the Social Security Administration, it is not funded in the same way our Social Security typical benefits are funded. SSI is funded by the general tax revenues of the federal government, not Social Security taxes. And so when you hear and read about the Social Security Trust Fund and issues with there, that will not affect SSI, because SSI comes from the general funds of the federal government. It's generally designed to help the aged, blind, and people with disabilities who have little or no income and resources. And we'll talk a little bit about what that is. The disability is expected to last more than 12 months or result in death. The idea behind SSI and most of these disability programs is that they're meant to help folks who have long-term disabilities. Meaning that if you hurt your back and you're expected to get better in 6 months, that's not someone who these programs are geared towards. And SSI as a government stipend, this is a monetary benefit, is meant to provide the basic needs for someone with a disability. Those basic needs are defined as food and shelter. And that distinction is important to remember as we go through kind of what can reduce some of these benefits. And there's that 18, that age when someone becomes legally an adult, is an important milestone. If someone is considered federally disabled and they're under the age of 18, the parents' assets and income are deemed available to that individual, which is why most people who are under the age of 18 do not get SSI. Once the person reaches 18 and they're considered a legal adult, even if they're not able to manage their own affairs, SSI is based on their own individual assets and income from then forward. Now, the maximum amount that you can get for SSI sometimes referred to as the federal benefit rate or FBR, is $750 a month in 2018. Next year, there's going to be a small raise. And so starting in 2019, the SSI amount is going to be $771. But in order to access SSI, you have to have less than $2,000 in income. $2,000 in countable resources, meaning assets, and a limited amount of income. Essentially, about 2 times that 750 is the maximum income you can have in order to receive SSI. But don't get too excited about that $2,000 you can have, because if you need other benefits here in Connecticut, that limit might be a little bit high. So what counts as a resource? A resource is anything you own, such as cash, bank accounts, stocks, savings bonds, cash value in life insurance, personal property, and anything else that you can own or that can be exchanged for cash and used for food and shelter. Those are the resources that count towards those $2,000. There are a bunch of exemptions that are listed here. The most important one is a house. If you need access to SSI, you can own your own home. Not a great idea, which we'll talk about if you need Medicaid-based benefits and services, but you can own a home. You can own an automobile and still qualify for SSI. You can have a burial plot, and that does not count towards it. And all these other pieces. On the bottom of the screen, by the way, you see a reference to the Social Security Programs Operations Manual System, the POMS. The POMS are rules to Social Security. And so if you're wondering why you're not getting something or how something's worth to Social Security, everything there is under the POMS. It's just hard to find and hard to interpret, but it is there if you want to do that research. But if, with the exceptions, if you have less than $2,000 in the bank, then you can access SSI. So what is income? So SSI is a needs-based program, meaning that you're getting that $750 a month in 2018 because you have no income and limited assets. If you have some income, there will be a reduction in SSI, because the idea is they're giving you the $750 for food and shelter. If you have access to help from family members, from income, you don't need the government's help, and so they will reduce your SSI. So how does SSI get reduced for income? Well, let's make a distinction between earned income and unearned income. Earned income is wages, money that you earn by working, and unearned income is interest on checking accounts and savings accounts, income from investment accounts, although you probably don't have too much if you're qualifying for SSI, and someone giving you free stuff that can be turned into food and shelter counts as unearned income, and that's an important distinction. So typically, you get to keep the first, for unearned income, you get to keep the first $20 of gifts or unearned income that you get from people during a particular month. And this is all governed month by month. After that $20, any other dollar of unearned income reduces SSI on a dollar-for-dollar basis. Meaning, if grandma writes a check, a birthday check for $100 for someone who is receiving SSI, after the first $20, the remaining $80 of that $100 check will reduce SSI dollar for dollar. That's why it can often be important that if grandma wants to write a birthday check, they don't write it to the person who's receiving SSI. Maybe they write it to the parent to not run into that issue. For earned income, wages, if you are able to work a little bit, and but not enough that you're no longer considered disabled, but able to work a little bit, the penalties for working are not as harsh. You get to keep the next $65 of earned income, So $85 of total if there's no other gifts to you. And then once you hit the $85 in a particular month, you only lose 50 cents on the dollar of your SSI for working. So there is a benefit if you are considered federally disabled and able to work part-time. There is an overall benefit. You don't get to keep all the money, but you get to keep a good portion of it. So there's another concept called in-kind support and maintenance, which we'll cover in the next slide. But certain things don't count. Other things that don't count as income are certain medical and social services, income tax refund, personal services, loan proceeds. And keep in mind that Social Security looks at this on a month-by-month basis. They're going to look at how much you earn in a particular month to determine whether you qualify for SSI or not. But if you get income in a month and then you don't spend it, it becomes an asset or a resource in the following month. That's an important thing to keep in mind as you're managing everything when you're receiving this benefit. So again, here's just a slide that just goes through how it works again for unearned income. After the exclusion, you lose $1 of SSI for $1 of unearned income. If it's earned income, it's 50 cents on the dollar. If SSI is reduced to 0, you may lose your Medicaid in that month. Now, Medicaid, we'll cover in a second, is a little funky because each state gets to decide how Medicaid works. SSI is federal benefit administered by Social Security, and the rules are same for every state. Medicaid rules are different from state to state. Connecticut has some odd Medicaid rules, which we'll cover in a moment. But it's important to make sure as you're managing these benefits to at least keep SSI above 0. And that's the easiest way to keep other benefits and services you may be eligible for that you may need to manage your life. So I want to focus on one thing that I covered briefly on the other slide, which is something called in-kind support and maintenance. So it was mentioned that my son is 20 years old. We applied for SSI for him 2 years ago when he turned 18. And when he got his SSI, he didn't get the 750. He only got 500 because of a concept called in-kind support and maintenance. And the idea and the concept behind it is SSI is meant to provide food and shelter. If the person who's receiving SSI is getting free room and board from their parents when they turn 18, that's considered unearned income because someone else is providing the food and shelter that SSI is meant to provide. And if you think about Connecticut, the value of that room and board is probably greater than the $750 he would have received. And so what happens is that free room and board is considered unearned income, called ISM, in-kind support and maintenance, and would ordinarily reduce SSI on a dollar-for-dollar basis until it got down to 0. But there's a special rule for this in-kind support and maintenance, and it says the maximum it can reduce the SSI is 1/3 of the federal benefit amount. And so since SSI was $750, 1/3 of that is $250. My son Ben only received $500 because prior to getting SSI, he had no way of paying for his own room and shelter. It's kind of a catch-22 there. So what are the ways around the reduction in SSI for this in-kind support and maintenance? One is the individual can pay for their pro rata share of expenses. So if you add up the food, mortgage, real estate taxes, or rent, if it's a rental as opposed to a home you own, heating, fuel, gas, electricity, water and sewer fees, and garbage removal, if you add all that up and divide it by the number of people in the house, and you're charging your child that pro rata amount of their expenses, then they will be considered paying their own way and therefore not getting free stuff, considered in-kind support and maintenance, and therefore not get a reduction in SSI. However, in Connecticut, If you add all that stuff, including the property taxes for a home that you own, it's quite possible that their pro rata share may be more than the $750 they're receiving in SSI, so they couldn't possibly pay for that. The other option to not giving free stuff is to pay market rent. But again, and you can do some research in your locality to see what it costs to rent a room in a house. That may also, though, be more than they can afford through the full SSI. There may be some other ways of looking at this, but if your child is not receiving the full SSI amount, this in-kind support and maintenance is probably the reason why. And it'd be important to work through how to work around that. So let's move on to Medicaid. In most states, when you apply for SSI, if you qualify, you also qualify for Medicaid. And that's true in about 34 different states. Connecticut is not one of them. Connecticut is a separate application for Medicaid. So typically when you apply for SSI, you call Social Security, go down to your local Social Security office, and go through the application. For Medicaid, once you've been determined to be federally disabled by Social Security, you have to make a separate application to DSS, the Department of Social Services, and apply separately. That's important because sometimes I've found families apply for SSI and don't bother to apply for Medicaid because they didn't know they had to. Now, what is Medicaid? Medicaid is a jointly funded federal and state program for health insurance for low income and needy people. It's a medical insurance program. The federal government pays half the bill and the states pay half the bill. It's specifically meant for children, the aged, blind, and disabled, and other people eligible to receive federally assisted income maintenance payments, which is SSI. It's administered by the state Medicaid agency. Here in Connecticut, it's DSS. And traditionally, starting back in the 60s when Medicaid came around, it provided institutional care for the aged, blind, and disabled. Nursing home care, institutional care. It does more than that today, but that's how it was set up originally. And so in Connecticut, actually, we have 4 different flavors of Medicaid, especially with Medicaid expansion, for different populations. There's Husky A. Husky is Connecticut's term for Medicaid. There's Husky A, B, C, and D. Husky A is for low-income families with children. Husky B, sometimes referred to as CHIP, is Medicaid for children only as health insurance for those families where they make a little bit more than they would be eligible under Husky A. Husky C is traditional, if you've heard of Title 19, is traditional Medicaid for the aged, blind, and disabled. And if you need services from the state through, say, DDS, the Department of Developmental Services, that serves folks with intellectual disabilities, you would need to be on Medicaid, on Husky C, Medicaid for the aged, blind, and disabled in order to get services. And then finally, there is Husky D, which is Medicaid for low-income families who don't have children. So it can be confusing because there's different kinds of Medicaid here in Connecticut. What's going to make sense for your family member is dependent on what other services they might need and where they are in the process. To be eligible for Medicaid, you have to be financially needy. In most states, that means having less than $2,000 in assets, which is the asset limit for SSI. Connecticut is one of a few states that has a different rule. And in Connecticut, in order to get access to Medicaid, because we're one of those 209B states, here in Connecticut, you need assets under $1,600. So even though you can get SSI with $2,000 in the bank, in order to get access to Medicaid, you need less than $1,600. There also are a variety of what they call Medicaid waiver programs. And waiver means that the Medicaid Bureau in the state is waiving some of the financial requirements, some of the requirements to get services in an institutional setting for certain circumstances. And so, for instance, the home and community-based waiver system, the HCBS, is how my son, who has an intellectual disability, will get services from the state based on Medicaid without having to be institutionalized. So what does Medicaid cover as medical insurance? As medical insurance, Medicaid is broad but not deep, meaning that Medicaid actually covers a lot of stuff. It covers hospitalization services, physicians, nurses, some dental work, pediatrics, laboratory care and x-rays, prescriptions, medical supplies, certain transportation and emergency ambulance transportation to a hospital. It covers a lot of stuff. The challenge with Medicaid as your primary health insurance is that it's not deep. In order to get it, you have to find a doctor that takes Medicaid as medical insurance. And the challenge, especially here in the Northeast, is that the reimbursements are so low that it can be challenging to find a doctor who accepts Medicaid as primary health insurance. You should know that if your child qualifies for Medicaid, you can, and say they turn 18 like my son who gets Medicaid, you can continue to carry them under your private health insurance through the age of 26 under the Affordable Care Act. So just because they get Medicaid, if you can afford it and they have additional needs, you can carry them through your traditional health insurance. Or if they're over 26, you can actually purchase a private policy. You can't purchase it through the health exchanges. You can't get a discount on it because they're already getting Medicaid. But you can purchase a private health insurance policy. And under the Affordable Care Act, when you purchase a private health insurance policy to supplement Medicaid, it's based on the individual's age, not any health conditions that they may have. And that seems especially important for the population here because all of you have medical issues with epilepsy that before the Affordable Care Act would drive up the cost of that private health insurance. But with the Affordable Care Act, it's based on age only, not any medical conditions you have. Again, we talked a little about waiver programs, again, where they waive the requirements. They may be waiving the financial requirements, as they do for certain Medicaid-based waivers for kids under the age of 18, or it may be where the services are provided. So we're going to move on now to SNAP, the Supplemental Nutrition Assistance Plan, often referred to as food stamps. And it's a federally funded nutrition program to help low-income people buy food. You get a what's called an EBT card, which is a debit card, and it's administered by state and local agencies who determine the eligibility and determine the amount of the stipend that's given. In 2018, the maximum monthly benefit for SNAP for an individual is $192, and that is scheduled to stay the same for 2019. It can be used for food items, but not for things like alcohol, takeout food, non-food items such as pet food, vitamins, and medicines, and for hot food eaten in the store. So this can be on top of the SSI. This can be an additional benefit to help someone and help families support someone with a disability who needs assistance. And finally, in terms of the means-tested vouchers, there are Section 8 housing choice vouchers. And again, this provides low-income housing to persons with disabilities and low-income people. It's basically tenant-based assistance or project-based assistance, and it's based on income. There is no resource test. There is no asset test, that means, for these benefits, but you have to look into it. Currently, in Connecticut and in most states, there is a wait. And so it could take years before you get off the Section 8 housing wait list, but it's worth exploring, especially if you're looking to manage things over a lifetime. So that kind of ends the needs-based section of benefits. We're now going to go to non-means-tested benefits, which include Social Security disability income, Medicare, and using ABLE accounts to help manage some of these pieces. So we're going to cover Social Security disability income. This is a benefit that is not means tested. Typically, in order to qualify for Social Security, you would have had to have worked the requisite amount of time and paid into the system. Think about the traditional Social Security disability person. It's a worker who would work for 20 years, paid into the system, had a disabling event like a bad back, and gets to collect their Social Security early from that. Essentially, it provides, Social Security disability provides a monthly cash payment, and unlike SSI, because it's not a means-tested program, it is SSDI is not reduced if someone is working in certain circumstances. And then an important piece about SSDI is that once you've received your SSDI payment for 24 months, 2 years, you get Medicare. And again, there's a big distinction between Medicaid. Medicaid is for, one thing about that, aid, it's for folks with limited resources, and Medicare, which is strictly for seniors when they turn 65. But you can get it early from Social Security disability income. And again, one of the challenges is typically in order to get Social Security disability, you need to work for 40 quarters, meaning 10 years, and earning at least about $1,300 per quarter in order to qualify. However, there is an exemption. And that exemption is something called childhood disability benefits. It used to be referred to as disabled adult child benefits. They changed it a few years back. And the government makes an assumption that if you were disabled prior to the age of 22, and again, meeting that federal definition of disability, that you will never have your own working record. And therefore, if you meet that criteria, they will let you collect a Social Security disability income benefit based on the parent's work record once the parent collects Social Security based on them retiring and collecting it normally, becoming federally disabled themselves, or having passed away. When you collect a childhood disability benefit, you will typically get, while the parent is alive, 50% of what the parent receives in their Social Security check. It does not reduce the parent's Social Security check. This is an additional benefit similar to the spousal benefit for SSDI. And once the parent passes away, that benefit goes up to 75% of that. If you think about someone who is earning the maximum amount, remember, with Social Security, they don't count income above about $130,000. This will be more money and provide better support than SSI alone. Because if you think about it, if there's a Social Security benefit of $2,000 a month, the SSDI benefit for the childhood disability benefit would be $1,000. That's more than the maximum SSI of $750, and it's not reduced by working. And when the parent passes away, that would be stepped up to $1,500 in that particular circumstance. In addition, because this childhood disability benefit is considered an SSDI benefit, once the child receives it, they would get Medicare 2 years later. And that may provide much more comprehensive health insurance for an adult with a disability than Medicaid would. In fact, you can be duly qualified. You can be on both Medicaid and Medicare. And if you do that, Medicaid will pay the Part B premium that normally costs, say, about $165 a month. However, you don't get both. SSDI is considered unearned income for SSI purposes. And so SSDI will reduce SSI dollar for dollar down to the last $20 you get to keep for unearned income. But there's a special rule. Remember, we talked about how if you lose SSI, you might lose Medicaid. There's a special rule that says if the only reason your SSI went to zero is because of an SSDI benefit, you can't lose Medicaid. And that's an important piece, especially for folks who are getting services from the state. So There is one caveat with this childhood disability benefit. It affects someone like my son who will be able to work somewhat, which is this benefit is predicated on the child never being able to work. So if they work too much, they may lose access to the parent's Social Security record permanently. How does that work? Well, there's a weird Social Security disability, there's a bunch of Social Security disability programs that will encourage people to go back to work. And one of them is called the trial work period, which allows you to earn a certain amount of money to trial working and not lose your benefits. And that amount in 2018 is $850 a month. And essentially, if the individual ever earned more than $850 in any 9 individual months in a rolling 5-year period, they will no longer be considered a disabled adult child and therefore eligible for these childhood disability benefits. And so if you have a child who's able to work somewhat, like my son is, you may want to manage how much they work and how much they earn if they're getting close to this. And that happens often, say, for kids in my son's situation, where a lot of kids with intellectual disabilities work in retail. And what happens around the holidays in November and December, they're asked to work more hours. And that's 2 months out of a year. If that happens over 5 years, that's 10 months. If he earned more than that $750, he might lose access to my SSDI benefits. And so that's important things to look at. There are things that can reduce the countable income. I'm not going to go into great deal into them, but there's something called impairment-related work expenses, which are IRWE. And if you're able to, if you need supports to help you work, you can deduct that from your earnings to keep you under the caps for still getting access to benefits. So let's talk about a little bit about Medicare. Medicare is different from Medicaid. It's typically a health insurance program for people who are 65 years or older, or some people with disabilities under the age of 65, if you've worked enough or can access someone's work record to get into the system. Medicare has 4 parts. Part A, which is hospitalization, which is typically free. Part B, which is medical insurance to see doctors, which has a monthly premium based on income, which starts out about $164 a month. Part D, which is prescription drug program. But if you also have Medicaid, Medicaid is going to provide much more prescription drug assistance than Medicare Part D might, because the drug costs are lower. And then there's Part C, which is a Medicare Advantage plan. Many people who are on Medicare, because Medicare has certain gaps in its coverage, buy a Medigap or Medicare Advantage plan program to help bridge the gaps for things that Medicare does not pay for. But Medicare, as an important piece, is not means tested, meaning that you can have $1 million in the bank as a senior, also as a disabled person who meets the eligibility, if you qualify. And again, you're eligible if you work, generally for Medicare, you're eligible if you work the 40 quarters and are over 65, or are receiving SSDI, or are receiving childhood disability benefits. And there are certain other instances where you can get Medicare. ABLE accounts. So ABLE accounts started a few years back, and it was signed into law in 2014. It's currently available in about 34 states in the District of Columbia. There is not an ABLE account in Connecticut, but you don't have to use your own state, so you can use any ABLE account out there. ABLE account is important for those who are managing needs-based benefits, because monies in an ABLE account do not count towards the $2,000, or here in Connecticut, $1,600 for Medicaid to qualify. And unlike other types of programs that kind of hide assets from the system, ABLE accounts are able to be managed by the individual with disabilities. So we're going to go through a couple of the items there. So basically, in order to qualify for an ABLE account, you must have you must certify that you are blind or federally disabled and that disability occurred before you turn 26. There's some laws, there's some bills out there that might raise that age, but in order to access ABLE account, the disabling event must have happened before the age of 26. You can only have one ABLE account. So if you open the one in New York or in Ohio, you can do that. If you then want to move it when Connecticut finally gets it, you would have to close that account and roll the funds over. Generally, you can only contribute cash to an ABLE account, and those contributions are not tax deductible, and that will still be the case even when Connecticut gets one. The monies in an ABLE account grow tax deferred, and if those monies are used for what's called qualified disability exempt expenses, the money comes out income tax free and is not counted as SSI income. If you spend it on something other than qualified disability expenses, it will be considered taxable income and subject to a 10% penalty tax from the federal government. And so ABLE accounts can be a way, essentially, for someone with a disability to save for an item and manage expenses to take care of, in addition to the $1,600 they're allowed to keep in their own individual bank account. Also, unlike a special needs trust, the disabled individual can manage that money themselves if that's appropriate. And that's something very, very different than something that wasn't available in the past. Now, what are the limitations to an ABLE account? You can only put in $15,000 a year. So ABLE accounts are enacted under the same laws as 529 college savings account, which allow anybody to put in $15,000 a year, which means you can put in, your spouse can put in $15,000, grandma can put in $15,000. You could line people up and everyone can put money into a 529. In an ABLE account, you can only throw in $15,000 a year from anyone who's giving in. There is an exception that came in last year and last December, which was if the individual is able to work a little bit, they can put on top of the $15,000 that other people put in, they can put in their earnings and save for that. You can also roll money over from a beneficiary's 529 plan. So if you had saved for your, I meet a lot of families, say, with autism, where before the child was diagnosed, they had started funding a 529, and all of a sudden they have a child who will never go to college. With the rule changes, you can now roll money over from a 529 into an ABLE account. But again, that rollover is part of the $15,000 that can go in any calendar year, and so you'll need to manage that a little bit if there's a lot of money there in the 529. Money from a first-party special needs trust can fund an ABLE account. If you have, this is not a talk about long-term estate planning and for families with disabled children, but if there was a medical malpractice suit and that was funded and put into a first-party special needs trust, some of that money can be transferred from the first-party special needs trust, which has a trustee and a gatekeeper, to an ABLE account that the individual with disabilities can manage themselves. Give that person a little bit more control. If the ABLE account ever grows to more than $100,000, could take a while at $15,000 a year, it will cause SSI to be suspended, meaning that they'll know if they're receiving SSI, they will no longer get that while the ABLE account is over $100,000. But Medicaid is not affected. And if the individual is receiving SSDI, that will also not be affected. And there is some maximum balances. If most states that's over $500,000, it's probably not going to be an issue for most folks. One thing, though, to keep in mind with ABLE accounts is that it is considered, in order to get that exemption from Medicaid asset, there is a Medicaid payback provision in ABLE accounts, meaning if there is money in the ABLE account when the disabled individual passes on, Medicaid wants their money back. And while Medicaid does not charge interest, if you're receiving Medicaid-based services, Medicaid keep tracks of all the money they've spent on you. And if you have any money when you die, Medicaid wants to get paid back. That's why when we went through Medicaid, I mentioned that a person who's on Medicaid can own their own house. They don't count the house as an asset. But if they own the house when they die, Medicaid gets the house. That may not be the best way to manage that resource if you want to keep in the family. So in able accounts, to go back, what is a qualified disability expense? Well, right now it's not clear. It must be related to the disability. It can include education, housing, transportation, employment training, supported assisted technology and legal fees, as well as other expenses per future regulations. However, the final regulations have not come out. The only thing we know for sure, because it was given in an example, is that a qualified disability expenses does not include a vacation for the individual with disability. The Program Operation Manual Service, the POMS, that number there is where the final regulations will appear once they're finally written. Okay, so I've babbled on for about 45 minutes and gone through a lot of stuff. This material can be confusing. I know this workshop will be posted on there and we'll be able to provide you these slides. But I guess we're now going to open this up for questions.
Again, everyone should be able to see a little balloon at the bottom of their screen to go ahead and type your questions in there, and then we'll read them at that point. I do have a question as we're waiting for others. You mentioned briefly the Katie Beckett waiver. Are there any other programs or waivers available to families who, say, need some in-home care or respite services?
That's a great question. The answer is it depends. So each state, including Connecticut, gets to decide what kind of waiver programs may be made available. Typically, there are different waiver programs for different types of disabilities. So there may be specific waiver programs if you have an intellectual disability, i.e. an IQ under 70. There may be other waiver programs if there is with someone with autism. There are different waiver programs for folks who are blind. What I would recommend is that if you network with other families, and again, it's hard because there are so many of them, and yet so few, it's worth talking to other families to see what they're receiving with a similar diagnosis. If you are registered with DDS, because there's an intellectual disability as well as epilepsy, talk to your DDS caseworker. The short answer is it's not easy to find what different types of waiver programs are available out there, and they do change from year to year. But typically, if you're going to be accessing other social services, I would network with families and talk to your contacts with the state to see if there are programs. I'm more familiar with some of the ones through DDS, which for kids under 18 include family grants of up to, say, $5,000 a year. One of the challenge with respite waivers, of course, is in order to have a respite waiver, you have to have someone sign in that they were paid. And many folks who work with folks with disabilities like to take cash and don't like to put their name on a receipt. So you want to be careful that if you do get a respite waiver from the state, that you make sure the person is willing to sign the sheet that says that you pay them X dollars an hour. We've found that there are a lot of folks who will not sign that sheet, and it can be difficult to prove that you've actually spent the dollars that you've received in the grants.
Okay. And then I guess along with that, is there a way for people to go through their insurance company to say that they're in need of some in-home care and to kind of work with their insurance company to see if they would cover any of that? I know that's kind of a stretch.
That's a challenge. Typically, again, one of the challenges with our health insurance system is that it's meant to be recovery services, and meaning that if you were okay and then you had a debilitating event, they will help you get back to quote unquote normal.
Right.
But if you never, this difference I ran into with speech therapy with a lot of kids with developmental disabilities is that speech therapy and insurance was originally meant for people who lost their speech to a stroke. And 20 years ago, getting insurance companies to pay for speech therapy to help someone speak for the first time who had never spoken was not covered because it was not rehabilitative. And so getting respite from an insurance company is probably not going to happen.
Yeah, okay. That's interesting. I've never looked at it that way before, but I guess that makes sense.
Right, and that's part of this. Just because I cover something in a certain way is to give you an idea of if you were turned down, if you got less than you thought you were going to get from a particular benefit from the federal government. I'm trying to explain why that happened. It doesn't mean you didn't deserve it. It's just this was the way the government was looking at it. And now that you know that, you can then have the argument, well, it's not that way.
Okay. Well, if anyone doesn't have further questions, we'll go ahead and close the, oh, looks like we do have one.
I see that. So there's a question that comes through is what states have ABLE accounts? So there are at least 34. There's a great resource at ablenrc.org, which is a national clearinghouse for, they do research on different ABLE accounts in the various states. If you're looking to set one up, the important things to look for families are to ask yourself a couple of questions. The first is, does the individual want or is capable of managing their own monies? Because there are some states where the individual is able to manage their own monies, and there are some states that have plans where the individual is not able to manage their own monies. And you'll have to need to make a decision as to what is important. In addition, some states have make it very easy to get access to the monies to pay for things. They can issue debit cards. Some have debit cards. Some have checks. And some only let you get the money by filling out a form online. And so depending on how you're going to use the account, you may want a particular ABLE account that has easier access to money than others. Or if you're trying to give your family member access but want to restrict them a little bit so they're not spending too much, you may want to choose a state that has less access to dollars. Typically, ABLE accounts are not sold through financial advisors. They're typically sold direct to consumers because they're trying to keep the cost low and the way that they're anticipating these accounts will be used. And so typically the investments are limited to, say, 4 or 5 mutual fund-like investments in various investment styles. So there'll be a growth fund, there'll be a growth and income fund, there'll be an income fund, for example. But the best resource to look up the various ABLE accounts is ABLE, N as in Nancy, R as in Ralph, C as in Charlie.org.
And if people are interested in ABLE accounts, though, should they seek out an advisor at least initially to set that up, or to get help setting it up?
Sure. So certainly you can engage and work with your particular financial consultant to help decide which one might be most appropriate for you and your family. But for instance, we don't, for instance, me and my firm and most firms, because these are not sold through us, we can give you general advice on ABLE accounts, but you can't purchase them through us. You have to go and do that directly. And typically, if you're going to work with an advisor, you may want to seek someone out who has knowledge about these areas. Again, because ABLE accounts are not generally sold through your typical financial advisor, many do not know how they work because it's not something that they work with on a regular basis. And so generally when you're looking to do your long-term planning, you may want to seek out someone who has some more specialized knowledge.
Okay. Well, if there are no further questions, oh.
No, we got one here.
Every time I say that.
So we got one, someone saying, how do I balance SSI with SSDI, earned and unearned income? So typically, I'll use the example of my son, and I hope this hits what you're looking to do. For between the balance of SSI and SSDI, there is not much that you need to do. So for instance, my son Ben, when he turned 18, he started receiving SSI because he qualified as being federally disabled. He started getting checks for his SSI checks, let's call it the $750. And when you work as a student, so right now the money that he earns working, there's a special exemption when you're a full-time student that income will not reduce your SSI. When he turns 21 and finishes his program and stops being a full-time student in a year and a half, when he works, he will start seeing a reduction in his SSI. That will happen automatically. You are required when you're receiving SSI, or the parent is required, to report earned income on a monthly basis to Social Security, and they will do the math for you. In addition, you are supposed to self-report unearned income. It's generally a good idea to do so if they can track it, because the SSI and how you spend it is subject to audit on an irregular basis. It's kind of like auditing with the Internal Revenue Service. You're good until they audit you, and then you got to prove everything. So it is important when you spend your child's SSI to keep track of how you're spending your child's money. Because while you may never get asked, if you get asked 3 years later and you have to recreate what you spent your kid's money on, that can be challenging. But there is an app that's available from Social Security to report that income on a monthly basis. I hope that helps.
Thank you, Michael. This has definitely been beneficial information. I do appreciate your time and expertise.
Sure. So I have a question here. I got epilepsy at age 6, and I'm now 40. I'm not sure what is there a particular question about the benefits that goes along with that? How does this affect me? So again, the question from the standpoint of benefits goes to how it affects your ability to work. Because you are 40 years old, if your epilepsy impairs your ability to maintain that substantial gainful activity, if it impairs your ability to earn more than $1,180 a month, then you would be considered federally disabled. If you were able to work and earn your own Social Security record, if your condition gets to the point where you are no longer able to work, then you would probably qualify not as a disabled adult child, but you would probably qualify under your own work record and start receiving Social Security disability on your own work record, and then get Medicare 24 months later. If you could prove that you were federally disabled, again, it's not the onset of the disability, but when you were determined to be permanently disabled. If that occurred before the age of 26 and you can prove that, you may be able to use an ABLE account to accumulate dollars if you are also accessing needs-based benefits such as Medicaid and certain needs-based benefits from the state. I hope that helps.
And if anyone has any further questions about any of these programs, certainly give our office a call and we can direct you further, whether it's connecting with an advisor or even the appropriate state agency to help you determine your eligibility. But today's webinar has been recorded and will be available next week on our website, which is www.epilepsyct.com. And on behalf of the staff at the Epilepsy Foundation of Connecticut, I thank everyone for joining us and taking the time to view the presentation, especially for a topic that is not easy to understand. And I know we all have lots of questions about these sorts of programs. So thank you, Mr. Beloff, for your time.
My pleasure. And if you have any questions, you can reach out to me directly. Again, I think that these slides we'll make these slides available to you for as much as they will help, and we'll kind of go from there. Thank you very much for having me.
Thank you. Thank you, everyone. Have a good night.